Hey guys, how are you? We're back. Ready to start? All right. Just putting my phone on do not disturb so we don't get calls in the middle. Okay. I already have here a question, so let me switch to the chat. We have a question and a statement. So we'll start with the question that we have here. Maria, do you know how many hours you have completed? Does anybody know? So here's what I'm going to address real quick regarding the hours. We only have 24 people, but I'll address it right now. As far as the hours, pretty much the 75 hours is the 22 chapters. That's what we would consider completing the 75 hours, plus the exam. Now, what I've been doing is it's what they deem reasonable to cover all 22 chapters is the 75 hours. But the way I do it, I include already the reviews, I include the practice exams, those go into the 75 hours because in reality, if you guys notice, I go very slow at teaching the chapters. And if you do the math, the 3.5 hours times the 3 weeks or 3 weeks in 1 day, that it's the 22, the core chapters, right? It's way less than 75 hours. So for me to complement the 75 hours, I've included, again, like I said, I included open forum the last week, the practice exams, questions and answers. So that's what will total, between that and the exam, will total the actual 75 hours. All right, again, 75 hours just means it's deemed that you'll be able to do the 22 chapters. So how do you know that you've done your hours? I keep a record of all the hours that you've done by logging in. Zoom gives me a report of how long you were here and what was your attention. That's why I always talk about you having the camera on, because the more the camera is on, the better feedback I get from Zoom of whether you were in class or not, and if you're paying attention. So if you, for instance, if you're switching between the Zoom and chats and websites and all that stuff, Zoom tells me that you were not attentive the whole time. So every time you're doing something else on your computer instead of paying attention to me or to the book or the class that I'm presenting here, Zoom records that you did skip, that you did go somewhere else. All right, I pay for that service, and that's the only way that I could actually track what you guys do on your end, right? Again, there's a lot of schools that don't care, and they just put it out there. If you watch, you watch. If you don't watch, you don't watch. They don't care. They just care about the money. I actually ask you to interact, and I've been participating in other schools, and this is a long answer for a short question, but I just want to introduce you why it's so important that you participate. Because every time I ask you a question and I see your answers and I address your answers, it shows me that you're here. If you're not asking questions, or if you're not answering or asking questions or answering my questions, right? Then you're just a person that's listening, maybe, sometimes not even that. Because if you've noticed, sometimes I call you guys out, I mess with you, right? Some respond, some react, and some just, I guess I'm not even with the audio on in their home. You see my point? So I do care, for those of you that actually know me, and some of you already started to know me over the past couple of weeks, I do care about my students and their success rate. In fact, in this Saturday, I had an exam. I had 11 people, and 8 passed out of 11. All right? And the ones that failed, hey, it happens. Like I said, take the exam just to see at least where you are. But 8 out of 11 passed. That's how much I care about the students, all right? I put everything for you guys, and I hope you guys understand and feel that for me, right? So the 75 hours, so shortening it out, the answer, 75 hours is 22 chapters. If you've done at least 20 of those 22 chapters, then you're eligible to take the exam, All right, let's put it like that. Either way, you can reach out to me separate and say, Bruno, have I done my hours? And I'll run a report on your hours and I'll let you know. All right. The next thing I had here was a comment from, yeah, Maria, you still have a long way to go anyway. So, Jonathan said T-Mobile's having an outage. It's not just T-Mobile. I let you know it's not just T-Mobile because my phone is not T-Mobile service, but every tower that runs from T-Mobile is affected. So if you have a service that runs from T-Mobile, could have been AT&T, they bounce off T-Mobile, Sprint, they bounce off T-Mobile, and so on. It could be affecting your. So yeah, it's Verizon, AT&T, and all that. It's just because they, in case you guys don't know, all of them share antennas. It's just that whatever they pay for the real estate. So if Verizon pays an extra $1 to use T-Mobile's antenna, then more signal is transferred to them. So everybody was affected. Even VoIP services, so voice over IP office phones, a lot of people, I was not getting through to them either, all right? So not related to real estate at all, but so you guys know, if you're not able to reach somebody, try calling later on. It's probably nothing wrong, it's just these outages, okay? It's the whole conversion to the 5G. I don't know if you've heard about that, but the whole conversion to 5G is affecting a lot of people and a lot of businesses. All right, so it's 5:50. We have 29 people. Let's see. Who do we have here? Okay, good. We got Anna's here in the house. We got Melissa. Cool. All right. Courtney, you wrote something on the group chat as well. Let's see. You're asking when will be the exam. There's actually two options for the exam for this class. And it will be, I think it's the 2nd and the 3rd of July. Yep. So you finish the class on the 26th. And then the following Thursday and the Friday following that, it will be the exam. So what I'll do is I'm going to divide the class in half. Of those people that are eligible, I'll divide in half. So I'll have half of you on Thursday, the other half on Friday. So when you receive, yes, at 5:30 p.m. So it's not at night. Same as the class. So if you receive an email from the school saying you're scheduled for Thursday, all right? Unless you have told me before that Thursday does not work, it has to be Friday, right? Unless he's told me before, then Thursday is your exam. If there's anything contrary to that, just let me know. But pretty much that's what it is. I'll decide who goes on Thursday, who goes on Friday, unless, again, you tell me otherwise. All right? Any other questions regarding exams, regarding the school, regarding the classes before we hit this chapter? You do one or the other. So yes, it's July 3rd and no, July 2nd and 3rd. So it's Thursday and Friday. I'm looking at the schedule at the calendar right now. It's July 2nd, so that's a Thursday, and July 3rd, it's a Friday at 5:30. Okay. Shirley Elmore is saying hi to me or to everybody. Right? Say hi. Hi, Shirley. All right. Anybody else? Questions? I just noticed somebody moved my camera. All right, guys, just keep on putting in the chat. So let me see something here real quick. All right, I'm back. So what do we have? I don't know if connection is strong. You're talking slow and blurry. All right, if I'm talking blurry, I'm sorry. Talking slow, I always talk slow to make sure you guys get it. Is everybody having the same feedback? Am I Is it coming out slow and a little blurry? No? Jonathan, I hear clicking noises. That was me, maybe. No? So Jonathan, real quick, it's very easy. You get hydrogen peroxide, put in cotton, put in your ears, and we'll take all the ticking sounds. There is mic feedback. All of you, yeah. All right, mic feedback. So, I have my mic problem. Give me 1 second. All right, I turn off the mic, turn it on. Yes, Jonathan, you have tinnitus from all the flying. Is it still, all of you, is it still clicking? Still issues? Well, the connection is the same. Sounds like somebody's tapping the mic. Okay. All right, so hold on to it. I'm going to close down the Zoom. I'm going to come right back to Zoom, okay? Give me 1 second. I'll be right back. All right. Still? Clicking? Anybody? No? I see some fingers say no. Some say no video. Never mind. Okay. Got it. All right. So we're good to go? Sound is good? Right? No clicking, no nothing. Great. All right. So we have 39 people. All right. Take advantage now to ask questions if you have them. Still clicking a bit. All right, I'm sorry, guys. So I'll move ahead. If he for any reason, becomes unbearable, difficult to go through, then we'll end, and I guess whatever outage is going on, apparently statewide, because this started. I just came from Massachusetts, and as soon as I entered Jersey, it was happening. So I don't know if it's just something in the state of New Jersey or not, but we'll try to do this and we'll see how it goes. I mean, like I said, I have plenty of days cushioned into the class, so if we delay something for any reason, we will try to redo maybe later on or tomorrow. Okay. All right. So here we go. We're going to talk about financing. Natalia just said that she can hear me fine. Good. All right. So we're going to talk about financing. We have financing 1 because there's 2 parts to this. Chapter 15 is financing 2. We have conventional FHA and VA loans is what we're going to talk about today. At this point, you guys should already know what a mortgage is, the basics of the mortgage. Now we're going to get into a little bit more detail, okay? But by the way, my partner just said that it's my fault. All this is my fault. I don't know why. I mean, sound is my fault. All right. There we go. Financing 1. I want you to go to page 193. And in page 193, it says mortgage financing. Okay. And we're going to skip everything. We're going to go to this part right here in the second paragraph that says the amount of mortgage loan in relation to the value of a home is called the loan to value, most commonly known as LTV. Now, a few years ago, the down payment you needed to put in, right, was roughly 60% because the LTV was 40%. That means the maximum loan they will give you was 40%. And I'll explain all this in a second. Today, we have as much as 95 or even 100% LTV. That means that the loan that they'll give you is either up to 95% of the value that you're purchasing, right? Or 100% of the value you're purchasing. You guys got it? So back in the day, 60% down payment, and now started coming down all the way to no down payment. That's why there was not many foreclosures before. I mean, if you put 60% down, I mean, can't go wrong with that. So let's go here. And when we're talking about defining LTV, okay, we're always talking about, so let me put it here, LTV and down payment. That's what we're going to go over. These two together always equal 100%. Is this? Okay. So LTV and down payment always equals 100%. So let's say we're buying a house and they're going to give us a loan. Now the value of the house or purchase price, right? The value of the house is considered 100% in this scenario. And if they tell you that they will give you an LTV of 95% LTV, this means that it's the maximum loan, okay? Because LTV is the maximum loan they'll give you. So if we're going to take the 95% LTV, you're left with 5%, and this is the down payment. Good so far? Okay. So let's translate this into numbers. We're buying a house that's worth $100,000, right? $100,000 is the purchase price. The loan was $95,000 because it's 95% of the purchase price. How much was the down payment? $5,000. Simple enough? Yeah? All right. So let's assume that they give us the reverse in the question. They tell us that you're buying a house, purchase price, that's $100,000. Okay. And they said that the down payment is 3%. Down payment. There's $3,000. Guess what the difference is? The difference is the loan. Okay. You got two examples of how they could ask the question, right? And if you guys notice, it's always based on 100%, always based on 100%. Okay, so if they tell you that the LTV is 95, well, 100% value minus the 95 equals 5% down payment. In this scenario again, we're looking at $100,000 purchase, right? We know it's 95% is the maximum loan that they'll give you. So that's $95,000. The down payment was 5% of the purchase, or the difference between these two. So it's $5,000. If the question, so again, these are two possible scenarios. Let me divide them here. Two possible scenarios. So scenario 1, scenario 2. If they give you the down payment instead of the LTV, right? Then the difference between value, or the purchase price, the difference between these two is the LTV. So again, the same $100,000, we know it's 3% down payment, so it's $3,000 down. $100,000 purchase minus the $3,000 is $97,000, or the 97%. Okay? Let me know if you have any questions here before I move forward. Any questions? Pretty simple, pretty straightforward, right? All right. So no questions, moving forward. And we're going to skip all this stuff. We're going to go all the way at the bottom to where it says payment plans. Now comes a question. Ready? We've heard this word before. Amortized. Okay? I want you to tell me in the chat what this word means. Amortize. What does amortize mean? We talked about it last week. And Sarah still straight for the kill. Unbelievable. Paying off, killing, kill, splat. Wow. Okay, the bugs were hitting you this week, huh? Splat. Death, pay off, kill off, pay off loan. Yep. So paying down the mortgage loan. Jeff, let's correct that real quick. Paying down the mortgage loan. You don't pay down the mortgage. The mortgage is the lien against the property. Okay? You're paying down the loan itself. The note, yes. If you guys see it here, I already had the answer. It means to kill off slowly over time, because that's what you do. Every time you make a payment towards your mortgage loan, towards a promissory note, right? It reduces the principal amount that you owe, and they release the grip. Remember what mortgage means? Death grip or death pledge, right? So they slowly release the grip they have on your property. The more equity you have, the less grip they have on the property. Simple. Okay? As you pay down, they release it. Right? Just for fun, I want to show you here something really cool. So you guys already learned. Some of you guys already know what I'm about to do. But you guys already learned what this means, right? M-O-R-T, right, for mortgage. Right? Can you write it down? What does M-O-R-T mean in mortgages? See what we got? You guys are so negative. All death? Come on. Just death? Jeez. Leslie even puts with a capital D just in case we don't know that it's killing. Death. Absolutely. Now, I told you I was going to show you something really cool, right? So let me take this out. Ready? What does that mean? Who knows what that means? Who knows what that means? Wow. One letter apart. You see that? Did you ever hear? That's the first part of your salon name. It's Amor. There you go. Oh, Jasiel, loving your house. Sure. If it doesn't kill you first, that's what we said, right? All right. So, you guys ever heard that love and hate is like there's a very thin line between them, right? This is love and death, one letter apart, in the same sentence. Now, killing you softly. There you go. What was my point here? Very simple. One letter, right? One letter can change everything. I've mentioned this before, I'm mentioning it again. One letter can change everything. The whole meaning of a word. Notice that? Because all I did was replace, sorry, I don't have different colors here. But all I did in this example was replace the T for the A in the beginning. That's all I did. And it changes everything. The point, just like when I talked about free and fee, the difference between them is the letter R. When you guys read, okay, you have to make sure, you know, when I ask you questions and I always trick you because you don't pay attention to the question itself. When you guys read, you have to really take it slowly. I have a lot of people that I send them the report of their exam back, and that's a couple things that I'm preparing. Unfortunately, last week I didn't have a chance, but this week I am creating a quick video for everybody that did the exam and failed. More to explain where they had the issue, but I like people to review what they had wrong in their exam. So especially the practice exams, right? I like you to see what you have wrong, and before I give you my review of it, I want you to tell me what you saw you did wrong. And one of the people that did the exam, I sent it to her, and I said, just check it, because I saw at least 2 or 3 mistakes that I know was just not paying attention. So I will create something for those students. But before I said anything else, I was doing something else. Before I said anything else to this student, she replied to me and goes like, I already saw 3, and I know what the problem is. Right? Like, I didn't have to explain the question or the answer. You guys understand what I'm trying to say? It's pure distraction. One letter. Pure distraction. Most of the times. Okay? Let's see what we got here. Do the practice exams. Yep. Do them. You get the report. You get to see what it is. And guaranteed, 9 out of 10 times, it was pure distraction. Okay? I think you guys put so much pressure on yourselves that by the time you're taking the exam, you put so much pressure on yourselves. I gotta pass, I gotta pass, I gotta pass. That you start kind of like getting into panic mode, and you're no longer reading the questions, or you're overreading the question. You're reading too much into it. Sometimes it's just a comma. Sometimes it's just a letter. Sometimes it's not seeing when the word except shows up. And you guys are gonna notice this in the last. To hear, I saw something there. What was that? Rolled your eyes like, yep. All right, so, but my point is, in the last week of this class, we're going to have practice exams. And I'm going to show you several times how to pay attention to these things. I'll emphasize. But during the actual exam, I cannot be there with you. So make sure you guys learn the way I break down the questions. I guarantee you it will help. All right? So, completely out of mortgages, I know. But I found it funny when I saw this the first time. Love and death in the same sentence. A letter apart. Crazy, right? All right, let's go back here. Hold on. Yay, because I work full time. This is my busy. Could you explain what's the yay about? Was it about the love and death, or about the free, about the accept? Oh, the practice exams. Okay. Yeah, guys, they are, especially the ones I have online, they're available to you. I just don't recommend you do it yet, because most of you don't have the hours yet. But as soon as you've done at least 20 chapters completed, do the practice exams. Until then, you have Quizlet. Until then, you have the PowerPoints already. You have the replay of these classes. Okay, I haven't uploaded a few of them because there was issues on the sound. For instance, like you guys are telling me clicking, I would not use this class. But I have previous classes that sound okay, or they're clear, right? So just review them. Okay. All right. So very important, payment plans. By the way, today's class, most likely we're going to break it into two. So today and then tomorrow, part 2, and chapter 15 most likely into 2 as well, because it is that complicated for a lot of people. Thank you, Jessiel. I appreciate it. I did change my voice a little bit. I don't know if you guys noticed. Once we were talking about love and death, I went into the dramatic mode, and that's why I changed a little bit. All right, so payment plans. It says most mortgage loans are amortized loans, and the word amortize means to kill off slowly over time. We just went over this because that's what the amortized loan does. It slowly kills off a debt. Jeff, does it say mortgage? Is this word mortgage? No, right? Did I lose Jeff? Where's Jeff? Yeah, he went on break. Okay, so this was for Jeff because he wrote mortgage before. It doesn't say mortgage, it says debt. Mortgage equals house or collateral. Remember that? It's the document that the court, that the creditor can enforce a foreclosure with. But the debt is from the promissory note. I promise to pay. Okay. So at the end of the term, the full amount of the principal has been paid off. So when the full amount of the principal has been paid off, these are called self-liquidating loans. So that means you're making payments over several years, and the balance at the end reaches 0. Let's say you have a 30-year loan. The balance at the end reaches 0. That is a self-liquidating loan. Okay, self-liquidating meaning settling as you go. Next thing I want to show you guys, and I will slow down in a little bit this section, but right now just showing you something. I'm going to mark this here. Let me take a clip. This. Okay. You guys notice? Sorry, it's just that the lines are not defined here. I want to show you what happens over the years. I'm just going to point out this first one. I want you to notice one thing. The dark green, I'm sorry, the dark gray represents your interest. That's the dark gray area, right? Interest. The light gray area represents your principal. That's this part right here. Mark a little bit better. You guys notice what happens in your payments? You guys notice that the principal, what I'm marking here is in red. You guys notice that this is only a small portion of it goes towards the payment in the beginning. See that over there? And as the years go by, eventually you reach a point somewhere around here where it starts becoming 50-50. Right? So that means that your payments for the year, half of it goes towards interest, half of it goes towards principal. Now, before I move forward, I just want to show you guys one thing. How many of you are homeowners? Raise your hand, let me see. Homeowners. Okay. All right. So homeowners, do you pay rent or do you send extra money? Did you notice the question? Do you pay rent or do you send extra money? Tell me in the chat real quick. And be honest. There's nothing wrong. I just want to show you something. All right. Sarah sends extra money. Great. Nanette pays extra. Send extra money towards the principal. All right. Maury, send extra money. Okay. All of you are amazing. Blas says he makes 2 payments a month. You're balling, huh? All right. So, but why am I asking this question? You guys are exceptional, apparently, right? But most people that get into a mortgage, they act as if they are tenants. They just pay the minimum. They just pay, okay, my mortgage is $2,300 a month. I'm going to pay $2,300 a month for 30 years. That means you're giving all this money, guys, right here. Look, put this in green. All this money, you have to understand, interest is payable as you use. So you're giving all this money to the bank. Did you guys notice that the green part right here is way more than the principal? Did you notice that? Sorry, did you notice that? The green part is way more than the principal? Right. That's because when you buy a house and you finance it, if it's above a certain percentage, let's say 6%, you're paying almost 3 times your house. At 4% is 2.5 times your house. So you borrowed 300,000, you're gonna pay like 700,000 or 800,000 at the end. So you got to treat this as credit cards. Credit cards, we always send a little bit extra unless things are tight, and I understand that. But you always got to try to send a little extra, even if it's just $1. It makes a difference, believe me. Okay, a little bit extra towards what? Towards the principal, because the interest, as we're going to highlight later on, the interest is only for the amount of time that you used. So if you used for 30 days their money, once you reach the 30th day, they look back and say, hey, you used 30 days, so I'm going to bill you for the 30 days. And that's what happens with credit cards. If you don't pay it in full, they send you a bill with the remaining balance, right? Well, what they're assuming here, guys, and that's why it's so important for people to watch this right here. What they assume here is that you're going to take the full 30 years, to pay your loan. And they already pre-scheduled, that's the amortization schedule, they pre-scheduled all your payments as minimum payments, all right? Assuming that you're going to take 30 years to pay it. But if you, around here, need another color, hold on. If you around here, right, around here, pay off your loan. If you pay off your loan, guess how much interest you paid? Only whatever is here. How much interest did you save? All this. You see it? Because you only pay this interest if you carry over for the full 30 years. If you finish paying it off on the 15th year, then you paid interest for 15 years. You guys got it? Yes? Okay, another thing. Right here is roughly the 21st year. So after 21 years is when your mortgage payments, right, the loan payments, the mortgage loan payment, reaches 50-50. After 21 years, traditionally. So obviously depends on percentages, depends on a lot of other stuff, but 21 years. That means only the final 9 years, so this is just to correct something that Tamori wrote, the final 9 years, right, is when you really hitting the principal. Crazy, right? Some people just like to be tenants or don't understand this concept. So you guys have an opportunity to show people what to do. You guys got it? That's right. Because interest is only payable for the amount of time borrowed. And it's in arrears, it's not in advance. So at the end of the month, you're paying for the previous month's interest. Got it? And it's calculated per, we're going to talk about it also later. It's calculated per every 12 months. So there's something called accounting weeks, accounting months versus calendar months or calendar weeks. Nope. Courtney, the answer is no. You guys can go to bankrate.com only because they have calculators there, not for anything else. Avoid bankrate.com. So, or any of those like Lending Tree and whatever online. But you could go to bankrate.com, go to the calculators. I challenge all of you to do this. Go to the calculator and go to the one that says mortgage calculator. Just make sure you don't send me private messages because I see it shows up on the screen, guys. And if you have to step out to be back in 10 to 15 minutes, I'll discount you the whole day. Smile, Marie. I'm messing with you. Just don't miss more than that. Marie, I'm just glad you didn't send any picture. Right? That would be messed up. All right. So, guys, let's go back to this. What I was trying to say is, if you guys need to send me private messages, like I said, because I'm putting the chat here, I think being a little bit more interactive. If you need to send me private messages, send them to me on WhatsApp. You got my number, 908-418-8325. And that's my preferred method of communication. So WhatsApp, if I don't reply right away, send a bunch of messages. Keep on going until I answer, okay? But I do answer. It just takes a little longer. Now, what was I saying? Okay, Bankrate. Go to Bankrate and go to Mortgage Calculator with amortization schedule. Okay? And one of the things I want you guys to do, because we're going to talk about it in a little bit, one of the things I want you guys to do is compare. So I hope you're taking notes on this. Compare. You can put there a 30-year mortgage, $300,000, 4%, right? Everything is the same. The only difference is you're going to see how much your mortgage payment is for the 15-year, right? And then you're going to go to the 30-year, and it's going to show you a lesser payment, right? I want you to apply the difference between them. So let's say the difference is $1,000. I want you to take those $1,000 in the 30-year one, and there's an option there to put an additional payment every month. I want you to mark additional payment of $1,000. And tell me how long is it going to take for you to pay that 30-year mortgage. If the difference between them is $1,000, guess how long it's going to take for you to pay that mortgage? Take a wild guess. If the difference between the 15-year mortgage and the 30-year mortgage is just $1,000, guess how many years it's going to take if you put $1,000 extra dollars towards the 30-year mortgage? 11 years, 10 years, 12 years. Did you calculate already or just throwing numbers? All right. 14 years, almost 15 years. And guess how much you're going to pay in difference? Minimal. Because paying in 15 years, you're prepaying principal. So you just borrowed interest for another year or two. That's all it is. You know why I prefer 30-year mortgages versus 15? What do you guys think? Why would I prefer a 30-year mortgage versus a 15? I would never do a 15-year mortgage. I'll put it this way. If I could have a 100-year mortgage, I would. And pay it off in 10. Okay? Flexibility. Interest is lower. Cushion. You pay directly towards. Vlad should know. I mean, he's making double payments. You should know why. Gives you options in breathing room. Absolutely. Yep. Exactly that. Guys, you need to understand one thing. Most people don't know how to budget, right? So the moment you lose your job, you don't have savings. The moment you get sick, you don't have savings. So if you have, exactly. So if you have a 15-year mortgage, your monthly obligation, look, obligation, not monthly payment, obligation is higher, right? And to save what? A few pennies? Doesn't make sense. So it is higher. How about you apply, especially the type of business that I'm in and you guys are going to be in as independent, right? There are months we make a lot of money and there are months we make no money. You guys understand? I prefer to have lower payments, right? I prefer to have lower payments and send extra money whenever possible. If I have a closing this month, how about I dump the whole closing money towards the principal? You see what I'm saying? It's just giving ideas, but it is about the flexibility. It is about having that cushion if something happens. Absolutely. Me personally, I'll never get into it. Mortgage people, here's what they do. And I hope they're watching and listening because I hate it when they do this. Hey, you've been doing so great. It's time to refinance. Why won't we bring it down to 15 years only? Why not? They push into it. They care about commission. They don't care about the clients. There's very few, just like realtors. Unfortunately, there's very few that actually care about the client. You guys understand? So they call. I know somebody, unfortunately, well, I know him. Not unfortunately that I know him, but unfortunately what he was doing, especially in 2003, 4, 5, all the way to 2007, and even I think bits of 2008, what he was doing is every 6 months in an up market, every 6 months he was calling his clients. Hey, you told me you needed a car, right? Now's the right time. You got equity. Refinance. Here's the money for the car. Hey, you said you wanted to go on vacation. Why not? House went up in value. They just keep on shooting up. Just refinance. There's great products out there now. I can give you cash advance up to 100% now. And he kept on calling. I have one person that was my client years ago on a low modification. She refinanced 7 times within a year. 1 year. 7 times. But she got her Mercedes and got to travel to her country several times that year. And then, guess what happened? When market crashed, she became my client for low modifications. And the house was worth a third, almost, of what she had borrowed against it. All right? So, again, people forget clients are your source of income. You do good by your clients, they'll come back. You take advantage of your clients, eventually somebody's going to make a comment. And they can even sue you up to 6 years for taking financial advantage of it. Okay, that's chapter 3, agency, your duties, care, obedience, accounting, loyalty, and disclosure. You are a fiduciary. That means what? It means that they entrusted you with their money and their property. Okay? So that was just a short rant when it comes to this. Because we are in mortgages, you will not do the mortgage, but you'll have a mortgage rep. Make sure your clients understand their options. Even though, like from here on, guys, from here on, it has nothing to do with you. It's the mortgage person. It's going to be the appraiser. It's going to be the title company. It's going to be, does that make sense? It has nothing to do with you anymore. Attorneys and all. But we need to have this basic knowledge, including these things. Like Mr. Homeowner, if you prepay, if you can send extra, then you'll have equity. And one of the things you can do is you can borrow against your property without having to put actual cash into another property. And these are things we're going to talk about over the next couple of chapters. But coach your clients properly, train them. And you can turn one mortgage for them into 3 or 4 sales for you. Same client, buying 3 or 4 properties. You guys got it? Thumbs up? Great. So, this, got this. And now we're going to get into fixed rate loans. Here, when we get to fixed rate loans, I want you guys to write intended for long-term ownership. Because in the next few ones that we're going to explain, these are intended for short term. And again, guys, the reason why I go through this is because Even though we don't do this, we're the consultants. It's part of our job, if you remember, it's part of our job to help negotiate real estate loans. So it is your job to explain what is a long-term, what is short-term. In 2003 to 2008, nobody cared. They just went for adjustable rate mortgages, which are a disaster if it's for somebody that wants to live there for a long time. Okay, but we'll get there later. Let's start with fixed rate loans. The first type of fixed rate loan is called a fully amortized loan. If the word amortize means to kill off slowly over time, then fully amortizes, that means that once it reaches the end, right, then it fully pays off, correct? That means the balance at the end is zero. Now, a fully amortized loan requires the mortgager to pay a constant amount, usually each month. And this is the one that everybody traditionally knows. The fixed rate loan. Everybody traditionally knows like this. I pay $1,500 a month for 30 years, and at the end, the balance is zero, right? But there's other variations of this. We have a straight payment plan, which I'm going to skip, but when you see straight, it's a term loan, okay? And traditionally, interest only. So that's the only thing you need to remember right now about straight term loans are interest-only loans, because we're going to talk about them later. And then we have this third one, says when a mortgage loan requires periodic payments that do not fully amortize. If they do not fully amortize the loan, right, what we're saying here is they do not kill it completely, right? If you do not kill something completely, then what happens? It's still there at the end, right? So that means that at the end, the final payment, this is the key things about this one, is a larger amount. You hear the background music? Gotta love it. And I'm on the 3rd floor, imagine. If I was on the ground floor, this would be really loud. Oh, it's Mauricio. He's in the car, that's why he's blasting the music. All right. So, if it doesn't amortize completely, that means you have small payments. Let's say the payments are, as an example, they're $1,000 a month, right? But they do not fully amortize. And this is for 30 years, as an example. The final payment is, let's say, $20,000. So every month you've been paying $1,000 a month for 30 years, right? And then your final payment is $20,000. That means that the $1,000 payments was not enough. Okay? Was not enough. So the final payment is a larger amount. The final payment is a larger amount, $20,000, so that the balance reaches zero. This final payment is called a balloon payment. Balloon. Why? Because a balloon is an inflated amount. Right? If we have a balloon, we blow air into it, it inflates. It becomes a larger balloon, right? In this case, a partially amortized loan always has a balloon payment, an inflated payment compared to the monthly payments. Okay? So this is a partially amortized loan. It's not a fully amortized loan. Guys, real quick, help me out. Make sure you understood what I said. Go to the chat. If you have a fully amortized loan, what is the balance at the end? What is your final payment? Good. The balance is zero. and your final payment is the same amount as the previous one and the previous one and the previous one. It's constant every month. Got it? If you have a partially amortized loan, right? A lot of people fail in this. So I want you guys to make sure you understand. If you have a partially amortized loan, what is your final payment? Larger, inflated, amount greater than the consistent amount, balloon, absolutely. All right? So this right here, you need, yep, big amount, balloon. All right? You guys need to clearly understand this because there might be a question there. I'm not saying there is, but there might be a question there where they say, for instance, that your mortgage payment is $75 a month and your final payment is $4,000 a month. What type of loan is this? And then they give you options: fully amortized, partially amortized, and so on. Okay? Because you paid $75 every month, then your final payment is $4,000, $5,000, whatever, then this is a partially amortized loan. The final payment will bring the balance to zero, but it's not the same as the constant amount you'll be paying every year, every month. Okay? Any questions on this? Anybody? Hit me with questions. Questions? All right, so clearly understood? Great. The next thing we have are biweekly mortgages. Biweekly mortgages. Now, biweekly mortgage is not what most people think. As it says here, it involves half payments every 2 weeks instead of monthly. But some borrowers misunderstand this twice a month. It's not twice a month. In fact, let me cross this out. It's not twice a month. I'm going to show you why in a second. Okay? It involves 26 half payments, the equivalent of 13 monthly payments a year. And the extra money applied entirely to principal could reduce the fixed rate loan from 30 years down to 22 to 23 years. So you save 7 to 8 years by doing bi-weekly. Okay? Let me show you something. And this is very important also for you guys to understand the difference between twice a month and bi-weekly. Okay? How many months, guys, hit me in the chat. How many months do we have in the year? 12, okay? We have 12 months. Great. Everybody agrees to that. That's perfect. Okay. For accounting purposes, we also have 12 months. Now comes the tricky questions. How many weeks do we have the year? Okay. 52 weeks. See, the thing is that the 52 weeks, right? The 52 weeks, these are calendar weeks. You guys remember that we have different types of weeks, like there's the business week and there's the calendar week. You remember that? All right. Accounting weeks are also different. Accounting weeks are assumed based on the 12 months, right? And each 12 month is 4 weeks, right? So if we have 12 months with 4 weeks, then how many accounting weeks do we have? Or for the proper term, I saw somebody wrote there, was Shakia, fiscal accounting weeks, okay? Okay, so if you guys notice, there's a little difference. Calendar weeks, 52, accounting weeks, 48, right? There's a little difference here. Now, if we deduct the 48 accounting or fiscal, right? How many weeks do we have left over? 4 weeks. For accounting purposes, how many weeks are in the month? There are 4. So this equals 1 month. And that's why we have a statement here that what you're paying is actually 13 months. If you do biweekly, you're paying 13 months versus the 12 months. And why? Again, because there are some months have 31 days, some months have 28 or 29 days, right? We don't have even months, right? Some months have 5 weeks, some months have 4 weeks. You guys understand? So that's why we have an additional 4 weeks spread out throughout the year, total of 13 monthly payments. Stop me at any time if you did not understand something here, okay? Just let me know. The thing now is, if we do our math, we said 12 months, right? 12 months times $1,500 payments equals $18,000 a year. Let's say your mortgage payment is $1,500 a month, right? 12 months of $1,500 a month is $18,000. And this is, we're just talking about principal and interest. We're not talking about mortgage, I'm sorry, taxes or insurance or anything like that. We're talking about principal and interest only, okay? Now, we said that we effectively have 52 weeks, right? So when we talk about biweekly, 52 weeks, let's divide by 2, because it's every 2 weeks are going to make a payment. This equals 26. And we're going to divide this by 2. So it's times 750. Did I change your monthly payment here? Guys, let me know in the chat. Did I change your monthly payments? Tell me in the chat real quick. You were paying $1,500 a month. I just divided by 2. So now it's $750. Did I change your monthly payments? Perception is key. You guys are saying no, but I did. I changed your monthly payment by $125. Ready? Remember, I just divided by 2. Don't we have, don't we have 4 weeks extra? So we got 2 extra 750 payments. Okay, let's look at this. At the end of the year, we paid $19,500. It's the same 750 times 2, so that's $1,500. But we have, as some of you wrote, there's more frequency to it. See, if I was paying twice a month, then yes, the payment would not change. But I'm paying bi-weekly, and we just said that there's a difference between accounting weeks and calendar weeks. There are more calendar weeks than there are accounting weeks. If I was paying twice a month, then it would be based on this number right here, the 48. That means I will have 24 payments versus 26 payments. You guys understand? You guys got it? Is there anybody that didn't get it? Yes, no, maybe? Do the math. If you got a calculator, do the math. There's 48 accounting weeks in the year. Divided by 2. That means paying twice a month. That gives you a 24, right? Do 24 times 750. So if you're paying twice a month, right? 24 times 750. 24 payments of 750, then the answer is 1,800 a year. 18,000 a year, I'm sorry. So we're back to the same accounting. But because we used calendar weeks, the extra 4 weeks in the year, there's 2 extra buy payments, right? So there's 2 extra 750 payments. So that means the extra, all right? Let me just show you. Sorry. We have the extra $1,500. Isn't that what it is? Some of you have clear, I got it faces. Some of you have the Scooby-Doo faces. Like, huh? All right. Let me know. Let me know what the question is. What didn't you get? Anybody? There you go. You didn't get the 48 weeks or you got it? Where did I get the 48 weeks from? Okay, so that's the question right there. Darielle asked, Carlos asked as well, where did I get it from? Because I started off by telling you guys that the accounting weeks are established by the 12 months of 4 weeks each. Right here. For accounting purposes, we don't use calendar weeks, we use accounting weeks. So every month is divided evenly. It's 12 months of 40 weeks each. So that means there are 48 accounting or fiscal weeks. That's where I get it from. Okay? But the truth is that we have 52 calendar weeks. So if we do biweekly versus twice a month, right? Twice a month means we cut in half and pay half now and half later. Biweekly means every 2 weeks. So every 2 calendar weeks, we are making payments of $750. Because we have 4 extra weeks compared to the accounting weeks, right? Because we have 4 extra weeks, then we make 2 extra biweekly payments, the same as 1 month. Ariel, Carlos? Anybody else that has a question? Throw it at me. I see some cameras off. Don't forget, it will not count for your hours if cameras are off. Carlos, Ariel, did you get it or no? I'll explain again. Yes, no, maybe? Is there a picture of the 48 calendar weeks? Let me ask you something. Okay, I don't have a picture of it, but I will get one for you. My question for you is, do you get paid at work? Do you get paid bi-weekly or you get paid twice a month? That's the thing you need to think about. Courtney, 48 accounting due to holiday time taken away from the 52 plus in quarters for the fiscal year. So not just the holidays. For banking purposes, we're looking at Monday through Friday. 4 weeks, right? And then the holidays away and all that other stuff away. Yep. So not just the holidays, everything, Monday through Friday. So 4 weeks in a month for calendar purposes. How many weeks? So Carlos, Courtney, and everybody else, do we have 4 weeks in every single month? I just tricked you. The answer is yes, we do. The thing is, some months have 5. I just did to you guys what I usually do to my kids, just messing with them. Sorry. We do have 4 weeks in every single month. It's the same way we have 28 days in every single month. Right? It's just that some have 30, some have 31, and so on. I told you guys, perspective. Everything is a matter of perspective. So Carlos, some months have an extra week. January traditionally being one of them. January has 31 days, right? You got it? See what I'm saying? Okay. I understand. Sometimes visual is better. I could pull up a calendar. Actually, next time I'll have one. I have a student that did bring one to me, an accounting one, at one point, because of some students here. But it makes a difference. Getting paid every 2 weeks versus getting paid twice a month. It's a huge difference. All right. Are we good? All right, cool. David says he had a job that was twice a month and it switched to every 2 weeks. It was weird. Was it better though? I come from a country where I'm used to getting paid every month versus every 2 weeks or every week or twice a month or anything like that. Every month. Coming here and getting paid every week or every 2 weeks was weird. But it feels better. Like, you know, next week you'll have more money. The problem is most people, like I said, don't know how to manage it, right? Right? All right, let's see. When I got paid twice a month. Hold on a second. When I got paid twice a month, I had to wait longer and in between checks, so I didn't like that part. Twice a year, you get paid 3 times. That's right. All right, cool. So moving forward. Back to this. Now, I told you I had changed your payments. Let me show you something real quick. We already figured out that if you send an extra mortgage payment, and we're talking about principal interest, if you send an extra mortgage payment, it knocks down 7 to 8 years off your mortgage. We good with that so far? Right? Then I showed you if you pay bi-weekly, you're sending in an extra $1,500, right? But let's say your bank does not allow, or your mortgage lender does not allow bi-weekly payments. Some banks don't. They don't allow bi-weekly mortgages. They don't set it up that way. Remember, in New Jersey, they cannot reject you from prepaying your mortgage. Remember that? Great. So you have to ask your lender, how can you send extra money towards principal? Can you do it once a year, and that's the extra $1,500 a month? Can you make bi-weekly payments of principal and interest, and that will be your extra $1,500 at the end of the year? Or ready for some magic? The same $1,500. Let's just send an additional payments every month. If your mortgage is $1,500, your mortgage, just send an extra $125 a month. At the end of the year, it's the same $1,500. But again, you have to ask your lender how you can do it. Remember I said I had changed your payment by $125 a month? Okay. Any questions? Nope. All right. Question. Let's go here. So that was bi-weekly mortgages. Next thing we have is adjustable rate mortgages. So adjustable rate mortgages or ARMs, adjustable rate mortgages or ARMs. These are intended for short-term ownership. Short-term ownership. Okay? Now, why do I say this is intended for short-term ownership? They don't explain this to you when you go get the mortgage loan. They don't explain it to you. But I'm explaining it to you so you can explain to your clients. This is an amazing product if you intend to keep the property for a shorter period of time. Why? Because traditionally you have lower monthly payments than a fixed rate mortgage. The problem is the term adjustable. If it's adjustable, that means your mortgage payment also varies. Right now you're paying $1,500. Tomorrow you could be paying $2,000. Or maybe you'll be paying $1,000. We don't know. It varies. It goes up and down according to the market. Okay? So for long term, it's not beneficial because we don't know what the market is going to be 20 or 30 years from now. Are you guys understanding this? That's why it becomes very risky to get into these types of loans for a long-term situation. Now, what can you do if the rates drop, for instance? You can always refinance. You can get it and convert it to a fixed rate mortgage. So you can get into this one if you intend to sell the house in 5 years or less, or you can get into this one if you intend to refinance within the next 5 years. Beyond that, it becomes very, very risky. Within 5 years, it's risky. The people that got into this, look, this was very hot. It was a very hot program. 2003, 4, 5, 6, and 7. So for 5 years, it was a very hot program. Even in 2008, was still being pumped into the market, but very hot in these 5 years. What happened in 2009? Market crashed. So now, could you refinance out of it? Most people couldn't. So on the anniversary of these, so I'm going to talk about it in a second. On the anniversary of these, which will be traditionally a 5-year fixed rate and then starts becoming adjustable. On the anniversary of it, people got stuck with the variable mortgages at that time's rates. So 2009, 10, 11, and 12, these rates were 8, 9, 10% in certain areas. So imagine you started with a 3 or 4% loan, and now you're stuck. 5 years later, you're stuck with 8% or 9% loan. It becomes very, very risky. Are you guys clear on this? It's a great program. All programs are great. If anybody ever asks you, what do you think about adjustable rate mortgages? It's an amazing program. Do you intend to live there for a long term, or you intend to buy the house and then sell in the next 5 years? That's the question. All right? So very beneficial. And why do I say it's very beneficial? You guys remember the chart that I showed you where there's interest on the bottom and principal on top? You guys remember that? Okay. Did you guys notice that in the first year, barely anything went into principal? Right. So adjustable rate mortgages in the first 2-3 years is almost the same as you having a fixed rate mortgage. It doesn't affect your principal that much. That's my point. So having a lower payment is great. It all depends on what you intend to do. David just said to watch The Big Short. Yep. Jessiel, can you refinance once you have it before the 5 years? Listen, as long as you have equity, most lenders will allow you to refinance whenever you want, as long as you have enough equity for their programs. Some of them, they want to see that you're at least 6 months into it or 1 year into it, right? And that you have at least 10, 15, or 20% equity. Depends on the lender. You guys got it? So can you refinance within the 5 years? Traditionally, yes. Unless it's a program that you got into where they force you, like you bought a property from the city, right? There's certain properties you buy from the city, wherever you live, let's say city of Newark, where they tell you you can buy it, but you have to stay there. Depending on the program, you have to stay there for at least 5 years. You got it? That means you might not be able to sell it, and the lender might not allow you to, that might have other restrictions. Can they stop you from paying it sooner? The answer is traditionally no, they cannot stop you. So going back to it, a bank will consider you in a refinance. It's different than paying it off. Prepayment is different than refinance, right? So I'm just addressing this to be clear. Can you prepay tomorrow? Yes. Can you refinance? Based on lenders' guidelines. Some lenders will want to see that you're there for at least a certain period of time, or they'll work with the program that you got approved for by the city, as an example. So that's it's subject to guidelines. Blas just wrote, like HUD, yeah, housing and urban development. They have their own programs. They force you, if you buy one of our houses, you have to stay there for X amount of time. That's why you buy it under an LLC. The LLC stays there for 5 years. Nobody heard that. Okay, next. So adjustable rate mortgages are variable. By the way, whatever I say under my breath, if you guys hear it, it's just a few hints, but also do your research. Not everything is as simple as it sounds, even though everything is that simple. People tend to overcomplicate it by doing something called shortcuts. That's where you complicate things. Shortcuts. There are steps to take. They are that simple, but for some reason, people have step 1, step 2, step 3, step 4, all the way to 10. Once they've done step 1 and 2, they're like, oh, 10 is right there. Let me skip all these. And that's when they start screwing up in filing documents or lack of filing documents. All right, adjustment period. Every time you hear the word adjustment period, okay, adjustment period, we're talking about the anniversary on which interest rate adjustments may be made. So if your adjustment period is every 6 months, what you guys know, and take note of this, if it's every 6 months, what you guys know is that your interest is fixed for a 6-month period. If your adjustment period, right, is every year, that means every 12 months, you're going to have a new interest rate because it adjusted. It could be higher, it could be lower. I'll explain that in a second. But adjustment period is when the adjustments are made to your interest. They're locked. It's locked for a certain period of time. Okay? So you can write maybe lock period, okay? We'll call it lock. Because adjustment period is a lock period. It could be 6 months, 1 year, 3 years, 5 years, whatever the bank decides and whatever you agree to. Remember, there's always offer and acceptance, right? Okay. Next, we have index. Now, index market, like stock market. In this case, we're looking at the 1-year treasury bills, which is the most common index. All right. So index, if you guys ever seen the stock market, it's that ticker that goes up and down, right? A very crazy thing that I hate, that's why I don't do stocks, which is every 2 seconds that thing changes and gives me a heart attack. So no, not doing it. For some of you, you might love stocks, so I'm not going to discriminate against anybody. Like it, do it. If you're good at it, keep on doing it. If you suck at it, get your money out, get into real estate, because real estate is predictable. Stocks are predictable too, it's just within a certain margin. So you have to be on top of it. That's the thing I don't like. Okay? Ariel just wrote, mine changed completely today. What changed? Your stock? Whatever you put into it? All right, Tahir just wrote, yes, Real Estate Investment Trust Index. Best of both worlds, yep. Look, like I said, I buy the real estate. That's it. I'll get into anything that has. I'm not an aggressive investor. I'll put it like that. I guess you guys noticed already from the way I am. Not very aggressive in things. I'm a medium to low risk investor. So real estate to me is low risk. If I get into anything stock market, I'll get it through, for instance, a life insurance policy that gives me at least a floor or a guarantee that if the stock drops, or an annuity, where if the stock drops, at least my principal, what I've earned, is fixed, so I don't lose anything. You guys understand? But you want to make high returns? Yeah, high risk investments. The problem with high returns and high risk investments is that when it drops, just like your 401k, you went from, in 2008, you went from 401k to 201k, so like a 50% almost loss. That's the only thing I don't like about high risk investments. Anyway, going back to this. So index is that ticker, the stock market, and so on, right? Now the next thing we have is margin. By the way, guys, if you guys go to the YouTube channel and you search adjustable rate mortgages, I have a video that explains slowly and in detail, is solely focused on this. Slowly in detail explains what index, margin, and all that stuff is. All right, so I'm gonna go over here now. If you don't understand, I have a small video, just about 15 minutes, just for this, okay? So margin. Margin is what the bank gets paid. So I'm going to call bank payments. What they do is that the bank charges you a percentage above the index. So if the index is 2% in this example, right, and they charge you, let's say the index is 2% and they charge you 2% margin, then your interest rate, where you're going to pay, is 4%. If the index goes up to 4 and the margin is 2, then your new interest rate is 6. So again, I'm going to show you in a second how it plays. I just want you to highlight or take notes here. We got adjustment period is the lock period. Your mortgage is locked for a certain amount of time, right? So your interest rate does not change. We talked about index. That's the market, what the payment is based out of. So if you look at the stock market is going up or down, that's what your payment will be based on. And then margin is what the bank gets paid above that index. So for instance, all right, and I'm going to put on the board something in a second, but for instance, you have a $1,500 payment right now, a fixed, your fixed rate, right? The market goes down, the market goes up, your payment does not change. It's still the same, $1,500 for 30 years, right? Now let's say this is index, right? And up here is what you pay. This gap right here is the margin. If index goes up, the gap does not change, right? If the index goes down, the gap does not change, right? What changed was your payment because the interest changed. You guys understand? The margin is fixed. This gap right here is fixed. It's a 2% or 3% or 4% or whatever you guys decide from the beginning, right? Is fixed for the lifetime of the loan. What changes, the variables, is the index that goes up or down, thus changing your interest, which will also go up or down according to this. You guys got it? Yes, no, maybe? Okay. I'll talk about cap in a second. I just want to see if I have here it. Right here. So this is the one you're going to see in the video that I created. So this is an actual index. You guys can see it. It's an actual index. I know there's a lot of stuff here. I'm just showing you what I did in that video for you guys. There was nothing there. There was nothing in that video. It was just the index, and I started adding to it. What I want to show you guys is what happens in an index. This one, for instance, right? These are years. So what happened over the years? and it started, this particular index that I have was the 1-year treasury bill from 1960 to 1990. So I made it specifically for a 30-year period so I could give you a graph that represents this particular type of mortgage. Look what happened over 30 years. Index started at 3%, I'm sorry, and then it just went erratically up until it reached a point where somewhere in the 80s, they were right here. 17 index plus 2 or 3 margin. What was your interest rate? You see what I'm saying? At the time, you're paying 19 or 20% on your mortgage. Crazy, right? So, is this the type of loan you want for a lifetime, for 30 years? No. All right. That is a lot, Mauricio. That is a lot. But that's what was happening. Right? So if you guys go to the actual video that I have, it's this graph in detail. What I want to show you, I marked everything down and I zoomed in, zoomed out also in detail. What I want to show you is that in this scenario, I used a 1-year period, adjustment period. So every year it adjusts to a new interest rate. We started off with the index at 3. And then after 1 year, it went up 1%. After 2 years, it went up another 1%. After 3 years, it went 3%. So we kept on adjusting as we went. Okay. What the bank charges is the margin what the bank gets paid, right? So if we started off with a 3% index, and this particular loan has a 2% margin. So your initial interest on this mortgage was 5%. Not bad, right? You guys got it? Is there anybody that didn't get this yet? Let me know in the chat. Now we're going to talk about caps. Did I show you that at one point we had a 3% increase? It was the 3rd year, there was a 3% increase, right? Increases like that, they declare it as a payment shock, okay? Payment shock meaning it changes drastically how much you're paying every month. And most people are not ready for it. So they created something called cap. Now, what is a cap? A cap is, let's say, I always give an example of a water bottle I don't have here. But let's say I have this cup of water. If I fill it up to here, to the top, can I put more water? The answer is yes, I can, but it's going to go overboard, right? So the cap is on every single adjustment right here, on any single adjustment. If the market went up, the max that I can charge you is, in this example, 2%. You got it? If the cap was 3%, then how much could I charge you on the increase? I could charge you 3%. So what I have here, let's say this is a 2% cap. I can fill it up and charge you the increase. But if the increase was 3%, then it will go overboard by 1. You guys got it? So there's a 1% that the bank cannot charge you during the adjustment. It went up 3%. They can only increase 2, and there's 1 that's left behind. 1% left behind. Any questions here? Let me address Maria as you guys thinking about the potential question. Maria wrote, so the interest is made up of index and margin. Correct, 100%. Index plus margin equals interest. Absolutely. Yes, so the cap limits the index increase. The cap limits the interest increase. But yes, it's based on the index increase itself. So if the index went up 10%, they could not charge you more than X amount of dollars or percentage on that increase. So we go back here. I showed you guys in my chart that on year 3, the index was 5 plus 2 margin. We're looking at 7% interest. So you started off with 5% interest, right? and now you're at 7% interest. Maria just asked, the margin is agreed at the beginning and doesn't fluctuate. The only thing that fluctuates, so everybody knows, the only thing that fluctuates in an adjustable rate mortgage is index. And because index fluctuates, so does interest. But margin, cap, and lifetime cap, which we're going to talk about in a little bit, those are fixed for the lifetime of the loan. All agreed upon upfront. Okay? So year 3, 5% index plus 2% margin, we're looking at 7% interest. Year 4, what happened? Okay. So from year 4, 3 to 4, index was at 7. I'm sorry, it was index was at 8. The margin doesn't change, so your interest rate would have been 10. That means you would have jumped from a 7% interest to a 10% interest. Can they charge you a 3% increase? Based on what we just said, the answer is no. They can only charge you a 2% cap, right? So regardless of how much the index increased, the max that they could charge you was 2% above the previous adjustment. Okay? So that means if on year 3 we're at 7% interest, the max that they can charge you is 9% interest on the following adjustment period. Good so far? So your payment was $1,500 as an example. Instead of going from $1,500 to $2,000, again, payment shock, it goes from $1,500 to $1,700 or whatever I put here. So $1,800, $1,700. Okay? Again, to avoid the payment shock, it's lesser amount. So the bank has a 1% loss. This is what I have here. Instead of charging you 10, they're charging 9. They have a 1% loss. Now the thing is, the next adjustment period, the following adjustment period, if the market goes up, right? If the market goes up, I'm sorry, not bad. What I'm showing here is 5 index. So we were at 8 index. Let's say the market went down to 5. What the bank has the right to do is called recovering the loss. So even though we went down to 5, you should have benefited from it, right? What they can do is they take their 1% loss from the previous adjustment and add to this adjustment. So now we have 5 index plus 1% loss plus the margin. Your new interest rate is 8%. It should have been 7, but it's 8 because they had a loss from before. Any questions on this? Remember, market goes up, goes down. You benefit or you lose, depending on it, okay? Now, the other option, I'm going to show you all in a little bit. The other option is called negative amortization. Let's say they don't put the 1% on the new adjustment. Let's say they don't. What they traditionally do is they come up with something called negative amortization. Let's say that 1% loss represented $20,000. If that 1% loss over a year represented $20,000, what they do is you have a $100,000 principal. They will add the $20,000 to your principal. So now instead of owing $100,000, you owe $120,000. You got it? Nanette just asked, how back do they use the loss? That depends on the terms of the mortgage, but it could be used, if I'm not mistaken, it could be used at any time throughout the loan. So if we had the loss and the market went down, I can just flow it into the loan. Okay. All right, and that pretty much sums it up, that portion. All right, so I said it was a $20,000 loss during that period right there. You see that? In that period, there was a $20,000 loss. I just want to show one more thing, which is this bar right here, lifetime cap. So I told you the cap is the max that they can charge you right here. It's the max that they can charge on any single adjustment. So cap is the max they can charge on any single adjustment. I already showed you that the bank could use for the next adjustment period, right? So they can use the 1% to the next adjustment period so they don't lose their money, okay? The other option they have right here on top is that it could be absorbed by the lender. What does that mean? It's the lender telling you, hey, Michelle, I know I lost 1%, you benefit from me, don't worry about it. Whatever I lost, you never have to pay back. Don't worry about it, right? How many times do you think a lender is going to say that? It's my loss, don't worry. Barely ever, right? But it's part of the options. They either charge you at the next adjustment, or they take over the consequences, they absorb the loss, or the most common one that I was telling you guys is the negative amortization. This is the most common one, negative amortization, where they just add to the principal. So the debt, instead of decreasing, is increasing. Instead of killing you off slowly, you're resurrecting the debt, making it come back to life. That's what it is. This is the most common one. Good? Any questions here? No questions. All right, move forward. All right, moving forward, we have ceiling. Now, what is a ceiling? If you have a house, right? If you have a place to sleep, at least, right? You know what a ceiling is, right? It's the maximum room you have or elevation you have in your house, right? So when you buy furniture, you got to make sure it fits within that height, correct? Because above that is somebody else, or it's the roof. So you cannot put anything else unless you make a hole to go up, right? So the ceiling, when it comes to these mortgages, the ceiling is the max allowable interest rate. This is also called a lifetime cap. A ceiling is called lifetime cap. So look at, if you guys, I don't know how it is in your house, but for instance here, we have a drop ceiling, right? And then there's the actual ceiling, right? If you, a foot over or a foot and a half or whatever, there's the drop ceiling, there's the actual ceiling. Above the drop ceiling, we can still put stuff, is where we put the light fixtures, where we put the HVAC, everything goes through right above the drop ceiling. But then we have the actual ceiling. Once you reach the actual ceiling, can we put anything else there? No. And that's what you need to understand right here. Lifetime cap or actual ceiling. Doesn't matter what happens to the rates. Look what happened to the rates. They went crazy, right? Right there, they went crazy. The max that the lender can charge you is up to this ceiling. For the lifetime of the loan, they cannot charge you above this interest. You guys understand? So cap is at every single adjustment, they can charge you an increase. Okay? The cap is every single adjustment. They can keep on refilling the cup and charge more and charge more. You can keep on refilling the cup. No more than whatever the cup fills, right? Whatever goes overboard, this right here, represents a dollar amount. We could recover it in the next adjustment when it drops, right? Or we can add to the principal. We already got that, right? But the lifetime cap is the limit. It's where, that's it. We cannot charge you any more above this. You still have monthly payments, but the interest is capped. Mauricio just asked, cap is on every loan no matter the loan? No. Cap is on every adjustable rate mortgage loan. Okay? This is only for adjustable rates. That's why we're looking at indexes, because it's adjustable. And it wouldn't be fair if you guys notice right here. Let me bring this to me. Right? Imagine this right here, this hike. It wouldn't be fair. That's why they put a cap on how much they can charge every time these increases show up. Guys, throw me questions right before the break. Come on, throw me questions. Yep, it's like a safety net. We're going to look at it. It's called the worst case scenario. Right here. You want to know the cap, the lifetime cap, so it's a worst case scenario. We started off with $1,100 a month. Like Mr. Borrower, if you buy this house, your payment will start at $1,100 a month. If $1,100 a month, if the market goes up ridiculously up to 20 or 30 or 40%, the max that we can charge you is 13%, let's say in this example. So the ceiling was 5%. We started off at 8. The max we can charge is 13%. That means that today you started with an $1,100 a month. But worst case scenario, throughout the lifetime of the loan, the max that you'll ever pay at any given instance is $1,659 a month. Okay? Worst case scenario. Amado, can the bank come back and add any of the losses they incurred due to the ceiling? Yep, they could. Negative M. Yep. Again, everything is subject to the terms of the loan, but yeah, they can add. And there's a limit, by the way. There's a limit. Traditionally, there's a limit of how much they can add. Most of them come up with worst case scenario. If it keeps on negatively amortizing, the max that we'll charge is up to 150% of the original loan. So if you borrowed $100,000, the worst that could happen is you have to pay back $115,000. That's the max that they'll charge. So everything has some type of cap or limit, so it doesn't fall into usury or anything like that. Okay. Teddy's asking, can you appeal an adjustable? I'm not understanding. What do you want to appeal? For them to charge you less? What you can do is convert it. At one point, you can convert it to a fixed rate mortgage, but there's no appealing on something that you applied for. You're the one that asked for this loan. So it's different from taxes and appealing taxes or appealing zoning changes and all that stuff. It's different because those are imposed on you. Here, you asked for this type of loan. So what you can do is convert it or refinance. So some of them come with an option to convert, let's say 5 years from now. Or you have the option of refinancing at one point. Or you can call the bank and attempt what's called a loan modification. That means changing the terms of the loan. That's the only type of appeal that you can have. But traditionally, they won't change the terms of the loan unless you incurred some type of hardship. So asking just for asking is not going to do it. There has to be some type of hardship, right? And it's complicated. It's actually even more complicated than applying for a loan. For you to apply for a loan, we ask for the W-2s, we ask for tax returns, we ask for pay stubs, this, and that. For a loan modification, they ask for a hardship letter, they ask for all the same documentation, and they test you a month or 2 months later on the same questions and show me the numbers again. So this because a lot of people were committing fraud and creating their own pay stubs and other documentation that was needed. So I'm just saying, applying for a loan is a straight shot. Getting a loan modification, it's like applying for a loan 3 or 4 times within the same process. Let's put it like that. All right. The initial interest rate for a adjustable rate mortgage is called an artificially low teaser rate. Artificially low. And look what it says. That's how good this type of mortgage is. to induce the borrower to enter into the agreement. Did anybody understand what I just said? My example is always, if you guys like chocolate the way I do, let's say I got the best kind of chocolate in the world in my hands right now. If you run here, I'll give you the best chocolate in the world. It's one of a kind. It's limited. You'll never taste another one like this, right? Some people will run at it. They'll be here in 2 seconds, right? Don't come because I don't have it, okay? So don't stay right there. But my point is, they actually induce you, they tease you, right, to get into this type of loan. Why? Because the average rate, let's say, Jeff just wrote, induce like seduce. Yes, they seduce you into this type of loan. Yeah, they get you to fall in love with this loan. Absolutely. You know why? Because your neighbor bought the house and their interest rate is 5%. Yours is going to be 4%. You just beat your neighbor. Nothing better than that, right? It's the best feeling in the world is having something better than your neighbor. Just saying, right? The problem is your neighbor's is 5% for the lifetime of the loan. Yours is an artificial 4%, which could change over the years. Right now, you're winning because it went down to 3 or maybe even 2.5. Right now, you're winning. It's the time to do what? To convert, right? To a fixed rate. Now's the time to convert to a fixed rate. But what if you don't do anything and then the market just interest rates keep on going up? His is still at 5%. Yours started with teaser rate. Sounds unethical. Yep, but approved by all these regulating agencies. Real quick, some adjustable rates are assumable, and we already talked about being assumable mortgage or subject to a mortgage, right? Is when we purchase a property and we take over the mortgage payments. Some of them are assumable. And hybrid mortgage loans, these are a mix. It's a blend between fixed and adjustable. So during a certain period of time, they're fixed. And then most of them are like this. The first 5 years are fixed, or the first 10 years are fixed, or so on. And then from there on, it's adjustable. It goes up or down. Interest-only loans, as the name says, it's interest only. So that means that nothing is being amortized. At the end of 30 years, if you have an interest only for 30 years, at the end of 30 years, how much do you owe? The full principal amount. Okay? This is another one that's intended for short term, not long term. All right, guys? Hold on, we have a question. With a conversion, will the bank allow you to change from a 2.5% adjustable to a fixed 2.5%? Look, I can tell you that it depends on the lender. If the rate drops to 2.5, right? And they allow you to go to a 2.5, it depends on the lender. It depends on the equity you have, if you have, because we already know you could be negative, right? And you don't even know, you don't even feel it. So it depends on the lender and their current guidelines. They might tell you that because of the risk of the mortgage you had and other penalties that might be in place, whatever, they might tell you, okay, 2.5, but we're going to put another 0.5 point on top of it just for security, whatever. So now you're paying 3%. Still good because you started off at 4. Or if you were in 2006, you started off at 5 or 6%. Just saying. At one point, you were at 9 or 10. So anything below those is good. You guys understand? We got thumbs up? All right, guys. Here's what we're going to do. It's 7:38. We're going to take a break. 7:50, we're back. All right? But what I want you to do, don't go anywhere yet. Don't. Some people already started turning off cameras. Wait. I want you to think about what we just went through. All right, go take a break, go to the bathroom, go get water, go get coffee, but think what we went through. Throw me questions into the chat, so when I come back, I'll address those questions you guys have. We are not finishing this chapter today. Like I told you, I'm breaking into 2 parts. This is the most complicated side of this. And I want to make sure you guys understand, okay? So go do what you got to do, throw questions, and 7:50, we're back, okay? See you guys in a bit.